Hi there. Welcome to The Open here on BNN Bloomberg. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Shares of BP are down in the pre-market today. The oil and gas company's board has removed its chairman, Albert Manifold, effective immediately, citing serious concerns about governance oversight and conduct. Manifold only took over as chairman in October. His removal comes as the company was supposed to be turning itself around after years of poor performance. Shares of Ferrari are down in the pre-market after critics took a look at the carmaker's first fully electric vehicle. The unveiling of the Ferrari Luce drew largely negative reactions from industry analysts and social media influencers. The design of the $640,000 EV is being compared to mass market EVs. However, with a remarkable top speed, driving Ferrari's Luce might deliver different views. An American firm, Northern Oil and Gas, is acquiring a stake in Calgary-based Parallax Energy. The $350 million cash and stock deal is between the two privately held companies. It will give Northern a 25% interest in light oil producing properties and 75,000 acres in the Duvernay Shale Basin in Alberta. Under the agreement, Parallax will continue to operate the assets owned by Northern. And we're watching U.S. futures today. After an American holiday yesterday, it seems as though markets are heading for another all-time high. That's the case for the TSX as well. So yesterday, the TSX closed on another record high amid optimism that the tensions in the Middle East would soon be easing. Have to see if that's the case today, whether that optimism sticks around. But the TSX well above 34,000 points yesterday, almost nearing the 35,000 mark. Also watching the price of oil today, it is rebounding again as the U.S. strikes Iran, clouding the outlook for a deal to reopen the Strait of Hormuz. So we're watching that closely. Oil is down by more than 4% at the moment, so we're going to continue watching that. Gold, also on the heels of the news that potentially we could be seeing this war prolonged. You can see gold futures are ticking up ever so slightly this morning, so we'll continue watching that as well. And we're watching the price of Bitcoin today. Volatility hitting a 9-month low due to some subdued trading, with interest shifting away from the cryptocurrency of late. Bitcoin down at 77,000 this morning. U.S. stocks are poised to open higher on hopes of a Mideast peace deal and the reopening of the Strait of Hormuz. Meanwhile, the yield on the 10-year U.S. Treasury, which is the key benchmark for U.S. government borrowing, fell more than 6 basis points. Let's get some perspective now on that. So joining me is Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Good morning. It's great to have you join us.
Good morning. It's always a pleasure.
So why is there so much pressure on Treasury yields right now, particularly the long end yields?
Well, initially, we had a big sell-off in long-end Treasury yields. If you look at U.S. 10-year yields, they sold off basically 30 basis points in almost a 1-week time frame up to last week. But at that point, we started buying, and we thought they were overdone, oversold. When you look at the last 2 years, we're at the higher end of the range. So we think it's a good opportunity now to extend duration because, there could be a resolution here in Iran, and that will further reduce treasuries because then eases come back on the plate from the U.S. Because if you take out the inflationary aspect of the Iran war, then you could see Kevin Warsh really pushing for eases. So I think that comes back on the plate, and that's a reason why to own treasuries here.
What if there isn't a resolution to this war anytime soon? Because we keep hearing talks of peace deals. Obviously, that continues to not be the case in the long run. So what if this conflict continues for another couple of months?
We think if the conflict continues for another couple of months, it still makes sense to own treasuries here. We don't think inflation, even though it will be in CPI and stuff, will make the headlines until September. The reason why we don't think that is all the central banks will push back on this, push back on inflation now, basically saying it's transitory without saying that, resting their laurels on a possible deal. So we believe the Fed will have an easing bias. They haven't taken off their easing bias. So we believe they will push through until the fall with that. And then at that point, then you have to say inflation is persistent. If we still see it in September, October, then that changes the argument.
Okay, so it sounds like despite that impact from the war in Iran, you remain positive for growth in the U.S. in general.
Yeah, very positive for growth in the U.S. And it almost becomes a self-fulfilling prophecy in the sense that in April and May, the rally that we've seen in S&P is the equivalent of 10 to 15 trillion of new wealth. That wealth effect will keep markets buoyed. It makes people feel good about growth and spending. So we think the wealth effect will be very supportive of the market. Add in that there's still a lot of fiscal spending here. So the wealth effect impacts the private sector and the fiscal spending is the public. So when you have both engines basically roaring, I would say, it's very supportive of growth going forward.
What about for Canada's economy for the rest of 2026? Are you feeling as optimistic on that front?
Feeling optimistic, but not as optimistic. And the reason why is still 70% of our trades done with the U.S. So our very constructive outlook for U.S. growth is positive for Canada. We believe a lot of things that are but we have a lot of uncertainty here in Canada now. First, it was CUSMA, and now it's Alberta. So as long as Alberta and that referendum in September is on the plate, that adds uncertainty in Canada. It delays foreign investment here because they want to see the impact of that. So we think for at least the summer, it'll still be good because of the U.S., but less so than the U.S.
Yeah, it's interesting to see how the talk of separation there might really factor into things moving forward. I wonder then, is now a good time to have more investment in credit, such as corporate bonds?
So there's two sides. So let me answer that. Yes, we are overweight credit. Having said that, valuations are very high, so there's very little margin for error. So we feel positive because of our outlook on growth. The positive outlook on growth means default rates in companies don't jump up, don't gap higher. That's why we like owning credit. Also, given that treasuries are at the higher end of the yield, you add on the credit spread to that. So although credit spread and the valuation of spreads are very high, the all-in investment yield is nice and attractive on the higher range of things. So there's a lot of reasons to be supportive of credit, but valuations are high. So we're long and overweight, and we maintain that position.
On the flip side, then, is there anything you're trying to stay away from right now, or you think investors should be staying away from when you factor in certain uncertainties? As you mentioned, you've got the conflict in the Middle East, you've got the referendum in Alberta. Where are you not going right now?
Right now, we're going everywhere. So the thing when you get really cautious, you want to stay away from high yield because that has the biggest risk. It's the lowest credit rating, the most debt. But our outlook on growth is supportive of that. Having said that, I go back to my statement where valuations are very high. We think they're justified given the present scenario. But if they get higher, which we expect risk assets to continue rally, especially if there's a deal. We will slowly be reducing our exposure there, not because we're worried about the market, but we think we'll have the one key factor that we know is going to stay here is volatility. So we'll reduce our exposure so we can buy back at better levels.
Okay, so both the Fed, the Bank of Canada announcing rate decisions on June 10th. Are you expecting an easing or a rate hike or for things to stay the same right now at this period in 2026?
So we expect things to stay the same, especially over the summer. Having said that, the market is discounting hikes, both in Canada and U.S., more in Canada, surprisingly, than the U.S., but discounting hikes. We don't believe in hikes in 2026. We believe that we will stay the same, unchanged for the balance of the year.
Unchanged for the balance of the year. I'm going to ask you for a prediction then for early 2027. What do you think about? Because I have heard some analysts saying they believe that we could see rate hikes by then. Are you in the same line of thinking?
I wouldn't say no. And the reason why I don't answer, I'm in the same line of thinking. We will reevaluate at the end of the year. If inflation is persistent throughout September to December, we think rate hikes are a very real possibility in 2027. So a lot of it depends on some resolution to Iran, because that's the driver of the persistence. And that will determine, it's almost binary. will determine whether a hike is more likely than an ease, and that's dependent on the situation in the Iran war.
Okay, yeah, I know a lot can change between now and the end of the year. Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Always good to have you on. Thanks so much.
Pleasure. Thank you.
Coming up, a new survey finds fewer Canadians plan to travel this summer and are planning to spend less. But one generation is bucking that trend. More on that after the break. Toronto businesses are bracing for a wave of FIFA World Cup tourists as the city scrambles to finish last-minute preparations. CTV's Heather Wright has more in this report.
Extra TVs are being hung up at Fox & John's, a restaurant and bar in Toronto's Liberty Village.
We're adding TVs basically anywhere we could fit them.
Bar manager Samantha Besteo says World Cup preparations began 6 months ago and include the hiring of additional staff and a new streamlined menu to help serve the packed crowd expected here throughout the tournament.
It's going to be such a fun time here just in the city as a whole, but it comes with a lot of nervousness and we kind of don't know fully what to expect. So we're kind of going into it super excited, positive spirits, kind of ready for anything though.
Liberty Village is used to hosting big crowds. The neighborhood is the unofficial gathering spot for fans of Toronto FC. But the crowds expected during the World Cup will likely eclipse anything this area has seen before. For the roughly 10,000 people who live here, the tournament brings excitement and some trepidation.
It's definitely going to be busy, but I think it'll be fun. It'll be a lot of good vibes.
With 45,000 fans expected to pack Toronto Stadium for each match, in addition to the fan festivals located nearby, the foot traffic through this part of town will be a big boost for businesses.
It's going to be interesting, I guess. There's going to be crowds of people. There's a lot of hype behind it.
Kevin McDougall owns Merci Mon Ami with his wife, a restaurant and catering business. It has survived the economic crisis of 2008 and the COVID pandemic. He says the economic climate right now is just as tough, and the World Cup will be a big help.
So the margins are tighter than they ever were. So something like this definitely will help increase volume, which increase, revenue. So your margins are still tighter, but you're getting more revenue.
So the World Cup kicks off in less than 3 weeks here in Toronto, with the city expecting more than 300,000 visitors over the course of the tournament. Heather Wright, CTV News, Toronto.
Okay, stay with us. We will hear from the Premier of Newfoundland and Labrador to get insight on the decision to reject an energy supply agreement that was reached by the previous provincial government with the province of Quebec. More on that right after the break. Stay with us. The Newfoundland and Labrador government is seeking renegotiations for an electricity supply agreement with Quebec signed by the former provincial government in 2024. For more, we sat down with Tony Wakeham, Premier of Newfoundland and Labrador.
A number of concerns with the current MOU, and they focused on three main areas: more value, more transmission, and more power. And those are the three areas that we want to focus on in terms of renegotiating with the province of Quebec.
So specifics with those three areas, you want to kind of maintain control, is that right?
Well, I think if you think about more power, for example, one of the things that the previous MOU failed in, according to the Independent Review Committee, was they didn't look at the economic benefit opportunities that could be had by Newfoundland and Labrador using its own power to develop its own industries. They focus more on the financial side, which was simply how much money can we get by selling our power. So what we're looking at now is what's that economic analysis look like if we were to use more power to develop industries in Newfoundland and Labrador. That's been a bone of contention for a while now. And just to give you a quick example, over the last number of years, the province of Quebec has seen their mining industry in the Labrador Trough grow by 125%, and ours has only grown by 45%. Now, this is the same area, the same minerals, the same activity, and the reason we haven't grown is because we didn't have enough power for our mining industry. So that's part of why when we talk about needing more power, that's exactly what it refers to.
Have you heard from the interim premier of Quebec on this front yet?
Yes, we had a conversation. I called her before the release of the Independent Review Committee's report to give her a heads up of what was in the report, and spoke to her about the opportunities to get together and to get back at the negotiating table and talk about what the art of the possible was.
What was her response?
Oh, very good response. We both want to see this resource developed. And of course, the federal government has a role to play here. We both believe that. You know, when we look at this particular project, for example, the development of Gull Island has been considered as one of the best, if not the best, hydro development opportunity in all of North America. The federal government certainly has an interest in developing hydroelectricity opportunities and the electrification of Canada and the energy corridor and all of those in the national energy grid. So this project and the Upper Churchill development all fits into the what the Prime Minister has been talking about.
Well, I wanted to ask you about that and whether you've been speaking with the Prime Minister about this as well, because I wonder if you're looking at exporting power generated in Labrador to markets beyond Quebec, potentially like throughout North America. And have you looked at whether the federal government might consider this one of the major projects?
Well, I think that's one of the things when we talk about more transmission capacity. You know, we've been under the old contract, and now we have not been able to export power through the province of Quebec, and that is something that Quebec has been our only customer, and the current MOU did not change that. So what we want is the ability to be able to transmit power through the province of Quebec. Obviously, that's something we will negotiate with the province of Quebec, but we think that there's an opportunity here to do that, and it's all part of the negotiation strategy.
Okay, we'll leave that there because I do want to ask you a little bit more broadly about trade, because your province exports to non-U.S. markets. Those exports have grown exponentially, but will exports be concentrated to crude products, or are you planning to diversify them more, like maybe more seafood and other areas?
Well, I think for us, there's a real opportunity here in Newfoundland and Labrador as you talk about expanding what our markets, and we've seen a decrease, somewhat of a decrease in reliance on U.S. markets, for example, for our oil exports. That's just one example of where there's a renewed interest in our offshore oil developments here in the province of Newfoundland and Labrador. The agreement that we've signed with Equinor on the Beta Nord project has certainly garnered lots of attention around the world. And given the instability in some places of the world, the one thing we do offer here in Newfoundland and Labrador is that security of supply, and something that I think the world, as long as the world still has a need for oil, we'll certainly want to develop it. And we're continuously looking at different seafood markets as well, and where we can export more product, and our mining industry, the same thing.
And based on those gains that we've seen in the oil sector, like particularly with oil prices, are you expecting the increased price to kind of offset the deficit in the budget for this fiscal year as it has in the past?
Well, that will depend on how long these prices stay where they're to right now. One of the things I don't want to do is start thinking about money that's in our budget before it's actually in our treasury. And while the prices are high right now, we have predicted a price for the entire year of around $79 per barrel, the U.S. Brent price. We know they're trading above that at the present time, but it's early on in the new fiscal year, so we'll have to wait and see how that all plays out.
You mentioned Gull Island earlier. I wanted to ask as well, apart from developing Gull Island, are you planning on any other major construction projects in the province?
Well, we've already talked about the opportunities when in terms of a new industry right in the island part of the province with our new floating dry dock, and the opportunity that could bring to bring new industries as well in terms of the national defense strategy, and an opportunity to be involved in the maintenance, repair, decommissioning of vessels. We think there's a real opportunity here. We have the workforce, we have the location, and we're looking forward to being part of that. We believe Newfoundland and Labrador is built for defense, and we're looking forward to being part of that defense strategy. We've already heard the announcement around Five-Wing Goose Bay, and so we're looking forward to working with the federal government as they identify other opportunities in the defense sector.
A new TD survey released today suggests Canadians plan to spend less this summer, with the majority of travelers planning to reduce travel costs and 44% saying higher fuel prices are affecting their travel decisions. 62% say they are redirecting spending toward essentials such as groceries, fuel, and housing. CTV's Renee Rogers joins us now with these findings. So, Renee, it's good to see you. When it comes to the survey, what are the highlights of it?
Good to see you as well, Lindsay. So I don't have to tell you that oil supply constraints caused by the Iran war are having a major impact on the price of oil, and then in turn the price of gas at the pumps, and in turn as well the price of jet fuel, which is raising the price of airline tickets. And it turns out that all of this is really reshaping the way that Canadians are planning their summer. So TD did a survey of about 1,500 Canadians in late April, and it found a few interesting things. And we have some highlights. I'm not sure if you have a graphic there that we can pull up, but one of the things that it found was more than a third of Canadians, or 35%, are cutting their spending this summer, with almost half of them pointing to high transportation costs. And as you mentioned, Lindsay, the majority of them are putting that money towards everyday needs like groceries, fuel, and housing. Now, close to half, or 44% of those surveyed, say higher fuel costs are influencing their summer travel decisions. Now, there is one interesting side note to this, and that is that a quarter of Gen Zers, or Gen Zers, born between 1997 and 2012 say that they actually plan to spend more this summer. And a third of them are pointing to social pressures, fear of missing out on things like restaurants and big summer events. But as a whole, most of us do seem to be on board with buying Canadian this summer. Now, if we do go to the next slide, there are a few more interesting findings when it comes to travel. So among those who do plan to venture out this summer, most say that they're actively reducing travel costs. And one way they're doing that is by not purchasing travel insurance this summer. In fact, close to half say they're not going to purchase travel insurance, despite almost a third saying that they would have trouble covering more than $300 in emergency travel costs without insurance, which TD points out, Lindsay, could carry real risks.
So interesting. Okay, that's CTV's Renee Rogers reporting live for us. Renee, thanks so much for that. Appreciate it.
You're welcome.
Coming up next, we've got the opening bells. Stay with us. Here are the opening bells at the NASDAQ. Rio Bubba is ringing the opening bell. On the New York Stock Exchange, MasterCard is ringing the opening bell. And on the TSX, BMO ETF and the ETF Market Insights community is opening the market. It's time now for the first 15. This is BNN Bloomberg. Trading is just getting underway, so we'll check in on the equity markets. We saw some record highs over the last couple of days for the TSX, but it is starting the day down ever so slightly by 0.3%. We'll see if it can rally. Obviously, it was rallying yesterday and on Friday due to optimism that maybe we'll see a peace deal in the Middle East. Now that might not be the case quite so quickly, we'll have to see what the TSX does today. But the S&P 500 still on a bit of a run, up by 0.5%. The NASDAQ up by almost a full percentage point at the moment. And we're watching a couple of Canadian stocks, of course. Curaleaf is one of the stocks we're watching. It's up by more than a full percentage point after it has announced a 1-for-3 reverse stock split in preparation for a U.S. stock exchange uplisting. So Curaleaf up almost 3%. Also watching Hudbay Minerals. Now, Hudbay Minerals was the best performer on the TSX to end the day yesterday as the materials sector was rallying, as I mentioned, but obviously now that there's less talk of a potential peace deal coming quickly between the U.S. and Iran, it seems as though a lot of gold prices are going down, a lot of the materials sector not doing as well today. Hudbay Minerals starting the day down by almost 2%. We're also watching some companies in the U.S. today as well. Dell Technologies, this stock up almost 4% at the moment. It's continuing to climb after getting bullish reports from Wall Street analysts following its annual Enterprise Technology Conference in Las Vegas last week and ahead of Thursday when it is scheduled to report results. So we'll be watching Dell Technologies throughout the day today. It's been climbing ever since March. Look at that. So we'll continue to watch that. Coming up, markets continue to show incredible resilience, but will an unpredictable conflict in Iran derail that rally? We'll find out after the break. Stay with us. Markets are hitting record highs, but with interest rates and energy prices staying high, how long can it hold if the Middle East peace doesn't last? We have Eddie Gabor, CEO of Key Advisors Wealth Management, here to break it all down for us. Good morning. Thanks so much for joining us.
Good morning. Thanks for having me.
So this is interesting. This has been one of the most resilient markets in our lifetime. What's really behind these record highs that we've been seeing?
You know, what's interesting is the real story is earnings. I mean, as I've been saying, this has been one of the strongest and most resilient markets of our lifetime, because in the face of a global energy crisis, with interest rates pretty much going vertical on the 10-year and 30-year hitting levels we haven't seen in 19 years, and yet the market continues to make higher highs. And when you take a look fundamentally, I think that tells us two things. Number one is the underpinnings of the economy is stronger than many people think. And earnings. I mean, earnings growth has been tremendous, especially in the technology space. So, you know, this market structure has changed. Volatility happens so fast. We had names drop by 20% in 3 days at the beginning of last week, and they're right back teetering on new highs. So I think investors have to be more nimble than ever. They have to pivot in the more concentrated areas if they want to achieve above average returns. And lastly, I'll say is we do expect another correction this summer. Energy costs are going to continue to stay high if there is no resolution in the Middle East, and that will be a headwind for the economy. But I think regardless of what happens short term, these corrections should be bought if you have the right risk tolerance aggressively, because I think we're going to be much higher when we get to the December 31st of this year.
Yeah, because you say despite these corrections you're talking about, you say the market is expected to finish higher by year end. So how much of this AI productivity boom is already priced into that?
I think we're just on the beginning of the productivity boom, because we're just now starting to see small businesses. It is the talk in boardrooms. I have had more conversations in the last 3 months than I've ever had in regards to the actual implementation of AI. So this is just getting started. So you're going to have two types of companies out there: those that implement AI for productivity, and those that do not are going to become obsolete, because that is the trend and the direction that we're going in. So I think we're just in the beginning phase of the productivity boom. Now, again, there's still going to be corrections and violent moves in the markets, but the trend looks extremely strong, and we're heading into a time period that frankly could get to much higher levels than many anticipate, because there's still a tremendous amount of pessimism in this market. So there's not that irrational exuberance you would expect to see when markets are at all-time highs.
Yeah, it is interesting to see that. When you talk about the correction you expect maybe halfway through the year, you say there's still some opportunities within that correction time period, like kind of buying on the dips. Where would you be looking?
So I think you have to stick with the same themes. I think you need to buy. A lot of folks are very underweight semiconductors because they've been afraid to buy it at high levels. I think you need to stay where the theme is right now, which is you want to own small caps. You want to own technology with a heavier weighting to the semiconductor space. And I think you can own emerging markets as well, too, because emerging markets, when we finally get a peace deal at some point in time, I think the international markets could benefit even more than our domestic markets here in the U.S., because they've been the ones hurt the most with this energy crisis. And so this market that has continued to stay concentrated, I think is going to stay concentrated this year, because technology already had a pretty big correction that started last year. And a lot of people are forgetting that. And that was your opportunity to really gross up. So any dips that you're going to get, I think you're going to see money flows go back in there because they're so underweight and have missed the V bottom.
Before we see dips, though, and a correction, I wonder if you expect markets to go even higher, and if so, like what is it that's going to take markets even higher than what we're seeing them at right now?
You know, I think the biggest thing to watch right now, obviously, the Middle East peace deal will be a big thing. But to me, the bigger thing is interest rates. If the 10-year note and 30-year note can just stop going up and just stay flat and trend down, I think you can see the market push to new highs going into June. But I would say as we start to get to mid-June, you know, if you've been overweight the right areas, it's probably going to be a time to maybe take some profits and see how we go into the summer, because we do think we're going to see a summer correction. It's going to be healthy. I think it's going to get bought, but it's a necessary thing to have when you're in a bullish trend. So I think here short term, we will make new highs, but we are getting to the latter innings as we head into the summer.
You mentioned earnings. The strong earnings report so far has helped to boost the markets up. So I did want to ask you about earnings because I know U.S. retail earnings are coming out this week. There's a couple of big companies reporting. You've got Dick's, Gap, Costco, American Eagle. What are you expecting just within that sector when it comes to retail and what we might see this week?
So retail's been pretty weak, and this is kind of a short-term warning sign that Walmart gave us. You know, Walmart to us has the best pulse on middle America, and they showed some concerns of spending by the consumer. So this kind of ties in with our theme that we'll get a summer correction, because I do think you're going to see these retailers start to warn of a summer slowdown due to the consumer not having extra income due to the price at the tank. So this slowdown economically that you could see will probably cause a scare in the markets. But there's a big difference between a slowdown and a recession. And we do not think we're going to have a recession. So this is why we would buy any fear that's caused from the retailers and other areas that are warning about a consumer that's still slowing their spending this summer.
What about tech? I know we've been talking about tech quite a bit, but we've got Salesforce reporting this week. Dell, what are you watching for there?
So again, we want to see guidance there in pricing power. Software has been an area that we have really been extremely underweight on because there's been a huge divergence. When you look at things like Salesforce, they have really struggled. Companies like Microsoft have struggled due to the fears that they're going to lose their pricing power as more and more companies adopt AI. So these are the things we want to see, is what their margins look like and what their future guidance is. And most importantly, is how the market reacts. Because that tells us more than anything. You can think something fundamentally, but sometimes fundamentals aren't going to matter. The price action and what the stock market is telling you is where you want to be. And this is something I think investors are going to have to learn.
Okay, Adi Gabor, CEO of Key Advisors Wealth Management. Really appreciate your time today. Thanks for joining us.
Thank you for having me.
Yesterday on Market Call, we were joined by Jamie Murray, president of Murray Wealth Group, and his focus was global equities. These were his top picks: Meta, Uber, and Flowserve. Joining us today on Market Call is Ryan Modesto, CEO and portfolio manager at I2I Capital Management. His focus is North American stocks, so be sure to stay tuned for that. Just ahead, several Liberal MPs are concerned that Mark Carney is backsliding on environmental commitments. More on that after the break. A South Korean submarine is docked in Victoria for joint exercises and to showcase its bid to replace Canada's aging submarine fleet. CTV's Adrian Gabriel has more in this report.
Promising to usher in a new era of middle power might, the Republic of Korea Navy cut through Canadian coastal waters this weekend. Be safe! Yeah! On board its KSS-3 submarine, a bid is in place for Canada to purchase 12 of these South Korean-made subs. The only other finalist vying to deliver Canada's next-generation submarine is a joint German-Norwegian bid. Ottawa will announce the winner of the contract this summer, which could come with a price tag of $25 billion. Korean Navy gave CTV News a tour inside the submarine that could be the centerpiece of Canada's naval future. We were forbidden from taking any of our own video inside. Korean Navy provided footage shows their crew in action. The submarine is more spacious inside than Canada's aging fleet, with the capability to deploy both anti-ship and land attack cruise missiles. The South Korean KSS-3 is 89 meters in length. It weighs 3,600 tons, can accommodate up to 50 personnel, and stays submerged for up to 3 weeks.
I just want to say thank you.
One of two Canadian submariners who traveled with the Korean Navy shared this analogy when comparing the Korean sub to Canada's.
It's kind of like buying a brand new Tesla, and then you're coming out of a 99 Honda Civic.
The Canadian Navy's 4 Victoria-class subs were first built in the 1980s. Only one is currently operational.
You have 3 oceans to patrol. How difficult does that make your job?
I do not have enough ships to patrol and to protect Canada like we should, which is why we're investing.
Currently, the Canadian Navy has approximately 200 submariners. They will need at least 1,000 strong to operate a fleet of 12 submarines.
This is all about democracy and freedom.
The ambassador of the Republic of Korea to Canada believes his country is well positioned to help protect Canadian coastal sovereignty.
Middle powers need to work together, and Korea stands ready to work together with Canada.
In increasingly troubled waters, the Canadian government is focused on forging friendships as it rekindles historic military alliances.
With a decision expected as early as this June, whoever is chosen to deliver Canada's next generation submarine is poised to play an integral role in shaping the country's Navy for decades to come. Adrian Gobriel, CTV News, CFB, Esquimalt.
Prime Minister Mark Carney is meeting with his caucus at 10 a.m. after a busy start to the week as reports from several Liberal MPs over concerns he's backsliding on environmental commitments has come to light. For more, we're joined now by CTV's Annie Bergeron-Oliver. So Annie, good morning. Let's start with Alberta, though, with separation top of mind as the Prime Minister is meeting with his caucus this morning. Can you give us the latest on what might be part of the agenda today?
Well, this is definitely going to be a big part of the discussion today at Cabinet, as is the Cabinet concerns that some may have around his climate policies. But let's start with Alberta, as you asked. So this is definitely something that took over the agenda yesterday, which was the first day that parliamentarians were back after a 2-week break. The Prime Minister was specifically asked where he stands on Alberta separation, and he says that he will be actively campaigning to ensure that Alberta stays in Canada. He was also asked about the question that's going to be posed to Albertans in October, and he said that he didn't believe it was helpful to have this type of a fundamental question asked. And he kind of brought up some experience that he had from Brexit when he was Bank of England governor, saying, that a lot of people didn't know what they were getting into when that vote happened, and that more than 10 years later, he said, those in England are still dealing with the fallout of that decision to leave the European Union. He also said this is potentially undemocratic, given that Danielle Smith did not campaign and did not win election based on a question that she was going to be posing to Albertans. So, it's interesting because also there was the Bloc MPs yesterday on Parliament Hill who, do have their own separatist agenda, but they believe that the federal government has to stay out of this and that this discussion on whether to leave Canada or whether to stay should be purely up to Albertans. And we know that the Prime Minister yesterday said that the federal government was looking at the Clarity Act to see whether this question that Alberta is going to be asking fits in with the Clarity Act. And that's something that the federal government is looking into. So for sure, this is something that's weighing heavy at Cabinet this morning.
Yeah, of course. Okay, so let's get to those multiple reports now that say Mark Carney's MPs are concerned he's backsliding on environmental commitments as the Liberal government moves forward with that pipeline deal with Alberta, as you mentioned. What can you tell us on that front?
Well, we know that, since this pipeline deal was announced, there has been one very loud critic, at least in the Liberal Party, and that was Stephen Guilbeault, the former environment minister under the former Trudeau government. He has been very outspoken, even stepped down from Cabinet in his position because he didn't like the idea of having a new bitumen pipeline from Alberta to the coast. He didn't want increased emissions, and he's been very critical of the federal government's climate policies. Now we're seeing that maybe there are more members of Parliament who feel the same way in the Liberal caucus. Supposedly 14 Liberal MPs wrote a letter to the Prime Minister in April with recommendations on how to strengthen their climate policies, ways that they can make changes to be more environmentally friendly and cut back on emissions, and also highlighting their strong concern with the government's policies when it comes to climate change and reducing emissions. And one of the big concerns there was the industrial carbon tax. It was supposed to be $170 per ton by 2030. The Prime Minister's new new deal with Alberta brings that to $130 a ton by 2040. So a reduction in the industrial carbon tax, and also a deadline that has now been pushed by about 10 years. So a lot of environmentalists don't like this. They say that, canceling the carbon tax for consumers, that was a big part of the Trudeau government push to bring down emissions. That has been canceled. The EV mandate, which was supposed to be 60% of all car sales, were supposed to be EVs by 2030. That has also been canceled. This push and reduction of the industrial carbon tax. Again, a lot of environmentalists are concerned with it, but now it appears that there are some in his own caucus that are concerned with where the Carney government is taking the country when it comes to its climate agenda. So again, this is a big topic on Parliament Hill today, and it's definitely something that's going to be coming up in cabinet as well today.
For sure. Okay, we'll leave it there for now. That's CTV's Annie Bergeron Oliver joining us live. Annie, thanks for that.
Thank you.
Coming up, FIFA estimates the upcoming World Cup will deliver about $3.8 billion in economic output for Canada. So how much of that will flow to the hotel industry? When we come back, we will hear from the CEO of the Greater Toronto Hotel Association for her outlook. FIFA estimates the upcoming World Cup will deliver about $3.8 billion in economic output for Canada. Representatives of the country's hospitality and tourism sector are also anticipating a lift. We got more from Sarah Engel, President and CEO of the Greater Toronto Hotel Association.
June is usually a very busy month for the hotel industry across the country, across North America. So what was a great June in a non-FIFA time can become a more difficult June because all of the food and beverage outlets and all of the citywides and business events are staying away from the city. Having said that, we are seeing that we have a lot of transient coming into the city, and the month is looking okay, but not as great as maybe we would have expected without the FIFA block dropping.
John, you want to join in?
Yeah, I'm sort of curious about one thing in terms of the international visitors coming in for these the events. Do you think there's been any impact? Because we went to book some travel recently, and I'm just astounded how much airfares have risen, obviously because of the cost of jet fuel. Do you see any impact on that already on the hotel industry in general? That travel from foreigners coming into Canada for a variety of reasons, obviously, but mostly because of higher fuel prices has been any sort of an impact yet?
Absolutely, it has been. I mean, all the geopolitical issues that we've been experiencing and oil prices and people taking longer to make decisions due to costs are all part of the impact. Another impact is, if we think about it, to host a FIFA World Cup across 16 cities, it can be a little bit challenging. While exciting to see all the different cities, when you're looking at fan base coming from international or across Canada or even the US, fans and tourists are going to think twice about their decision to follow their teams around if they have to, go back and forth to a bunch of different cities across North America.
It isn't a tiny continent, is it? I mean, that's a lot of travel involved if you want to follow your teams. Is this what kind of I mean, Toronto has so many events. Pride's coming up this month. Are coming up in a month. Is it having an impact on bookings for that at all? Are we seeing any concerns about that?
Yeah, well, actually, that's a great point that you raised. We have the Blue Jays, lots of games with the Blue Jays in Toronto and Pride Parade and a whole bunch of other events which are actually helping keep June a relatively strong month for the city.
One question I've got, and I live in Collingwood now. I come down to Toronto for work, but how has the nightmare of traffic in Toronto, particularly over the past year or two, making getting around difficult? Have there's been any dealings with the city to sort of lighten this impact during FIFA, just in order to make getting around any easier? Because that's going to impact travel as well.
I mean, the city would be the best person to ask that question directly, but definitely have seen a significant amount of effort put into getting people to and from the field during game time, and of course, Fan Fest. So there's public transit has heavily been elevated with lots of extra buses and trains going all around. And of course, fans who choose to come in for the games who are not from Toronto, they have a multitude of options for hotels to stay at. They don't have to stay in the downtown core. They can stay out in Mississauga, Vaughan, Markham, and have great public transit accessible to the downtown.
From a business side, is this almost a little overhyped? I mean, we have Bruno Mars in Toronto right now, and he's doing, I think, 5 or 6 shows and selling a stadium that's 50,000. How many people are we expecting from outside just to come in to either see the game? I mean, the game is, what, 45,000 maybe, and then all the events that are around it. How many people are you expecting to see for the games?
Well, I mean, the city's projected 300,000 fans. That remains to be seen. I mean, to your point on Bruno Mars, I was just visiting a hotel last week, and they were almost completely sold out for the whole nights leading up to Bruno Mars and beyond, because the production crew were staying at that particular hotel. So there is still an amazing buzz in the city with lots and lots of events. And we are excited to have the 6 games here in Toronto. And I'm sporting my great Toronto scarf for the game, and we are cheering Canada on.
And now, one of the notes you said you call it 6 Super Bowls. Does it still feel like it'll be 6 Super Bowls, those games?
Well, maybe a little smaller, but that's kind of the comment that I've been using, that it is 6 Super Bowls, and Toronto's never seen anything like it. And we stand to see a lot of positive aspects coming forward in future years when Toronto and Vancouver are on the map internationally as great destinations beyond FIFA.
Is that almost more important? Is that advertising for the city itself and the country? But is that more important than having bodies in hotel rooms over the games?
I think it's all important. It's, of course, having people stay in the hotels. We want the hotels to be busy and profitable and providing economic impact to the economy in Canada and the Greater Toronto Area. But the legacy pieces that have come with FIFA, as well as the long-term positive effects. I mean, I myself, sitting in my living room last summer watching some beach volleyball from the Paris Olympics, there's the Eiffel Tower behind them, and that's on my bucket list again for the next 5 years. And I think that a lot of people will discover Toronto, even if they haven't come to Toronto and Vancouver, and we'll see that piece of tourists wanting to come to Toronto and Vancouver.
And so the long-term impact, I mean, the FIFA saying $3.8 billion for all 3 countries. So you feel we will get that money eventually?
I'm optimistic that we will.
That was Sarah Engel, President and CEO of the Greater Toronto Hotel Association. Just ahead, chipmakers are on pace to extend a rally driven by AI. We've got more for you after this. Stay with us. Hi there. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following in the BNN Bloomberg newsroom. Canada is working on a comprehensive deal with India to boost trade and investment. This comes as Indian Commerce and Industry Minister Piyush Goyal is in the midst of a 3-day visit. Prime Minister Mark Carney says a deal with India would be a game changer for Canadian businesses and workers. The two sides say they hope to conclude a deal by the end of the year. And the combined federal and provincial debt is expected to reach $2.4 trillion. According to the Fraser Institute, debt has grown substantially since the 2008 financial crisis. The study also shows the combined government debt now equals about 75% of the Canadian economy. Manitoba has the highest combined debt share of the economy, while Alberta has the lowest. Shares of BP are under pressure today. The oil and gas company's board has removed its chairman, Albert Manifold, effective immediately. BP is citing serious concerns about governance oversight and conduct. Manifold only took over as chairman in October. His removal comes as the company was supposed to be turning itself around after years of poor performance. And we're watching the TSX today. It's in the red after seeing a couple days of green and record highs on Friday and Monday. But you can see today the TSX is down by 0.4%. We'll continue to watch that, obviously. The latest developments in the Middle East, which is more U.S. strikes on Iran, seems to be changing investors' optimism around what's going to happen there. If we take a look at U.S. markets, though, they're doing a bit better today, all in the green. The NASDAQ in particular is up by a full percentage point as investors watch some pretty strong earnings reports coming in the U.S. Most of the S&P 500 companies have reported a jump in first quarter profits as investors turn to AI-related names, including chip stocks, which are on pace to extend a rally. In fact, the semiconductors have been outperforming the S&P 500 since the start of the year. So let's find out more. Joining us is Greg Halter, Director of Research at Carnegie Investment Counsel. Good morning. Great to have you join us.
Thanks for having me, Lindsay. Glad to be here.
Yeah, this is interesting to see what's been happening with the S&P 500 as well as the rest of the markets. But what themes do you see evolving from first quarter earnings results?
Well, just in general, the results were incredibly strong, probably double of the expectations that were just set forth in January. So very, very strong. We have seen quite a bit of interest and performance in the AI related names, the power, the energy names. Those have done very well behind the scenes that people think about NVIDIA and so forth, but there's many of other companies that are helping all of this happen. And if we don't have power, these data centers cannot operate.
Does that include kind of the semiconductors as well? Is that because, as we mentioned, semiconductors have been outperforming the S&P 500. When it comes to AI, is that another area that investors are looking at now?
Certainly, they've certainly been outperforming. That's probably the understatement of the decade so far, given the performance of some of these stocks. We're seeing shortages. They're able to raise prices to almost any levels. Stocks are up 10, 20-fold. It's kind of getting crazy out there, but you look at someone like Micron, which was going to earn $1 a share, and now I see forecasts for $100 in 3 years. That's you've never seen anything like this before. So that's certainly helped to drive all of this stock price performance.
Yeah, and speaking of those kind of chip stocks, they've been trending higher. Do you see more room to run here?
Great question. It's generally not a space where we as a firm are invested a whole lot. We're more on the energy, power, tangential areas. But given momentum, the momentum is very strong right now. So I wouldn't be surprised if they can and do continue to move higher.
Do you think tech valuations are stretched a little too high right now?
No, actually, they don't seem to be on an overall basis. Despite the moves in the tech area generally, the PEs have not really expanded this year. So earnings are coming through very, very strong, and that is offsetting these valuation concerns at the moment. So but we also know that technology can change in a hurry, and the memory and semis historically have been volatile areas. So we'll see if that plays out again.
For sure. When it comes to tech, and I take your point, you like the power and energy side of things. Are there particular companies or names that you like right now?
Sure, there's names out there like Eaton, which we like, and Vertiv and nVent, and some of the utilities, NextEra Energy, Allegiant, LNT is a symbol there. Plenty of good utility stocks as well. A Canadian company called Solistica has done very well and has a play into the area. It's very broad in that perspective. But again, most people behind the scenes are not really looking at these companies because they're looking at NVIDIA and Oracle and the higher flyers, if you will, or the mega cap companies. But there's so much behind the scenes powering all of this and making it happen.
When we factor in some geopolitical issues or tensions, like what's happening in the Middle East, and it seems to be prolonged, no peace deal yet, do you think there could be an impact from that on tech stocks, particularly within the semiconductor manufacturing or export flows of that side of things?
It's certainly possible. I mean, we've actually heard for 4 weeks, 5 weeks, 6 weeks that there will be shortages of some of the components needed. including, I think, helium. But so far, that has not seemed to play out in terms of shortages or any great shortages that I'm aware of at this point. Maybe it will, but somehow, some way, the companies are finding a way to get it done. And that is the good thing about, I guess, capitalism is, if you have a product to sell and you can find a way, you'll get it done.
I mean, if this was to continue, though, for a prolonged period of time, do you think we would start to see some challenges? Like, how long can these companies continue to get it done without really elevated prices as well?
It's a great question, and I'm not sure anyone knows the answer, but prolonged for another 3 months, 6 months, a year, that would be a problem, certainly from the energy standpoint and the oil standpoint, where many countries need the energy to operate their economy. So yeah, at some point, this does become a point where it will be tough to recover from. Again, we need some sort. I think we need some sort of resolution in a earlier sort of time frame, if you will.
Mm-hmm. Okay, so we've talked a lot about tech, the semiconductor side of things, but you also are favoring rail stocks right now, and I wanted to get to that before we wrap up. Why is that? What do you like about that sector?
The three names particular there would be CSX, NSC, and UNP, three rails in the U.S. here. If you believe that the stock price and prices lead fundamentals, and that seems to be the case here because these stocks have done very well in the market, I think you're going to see improved business, which frankly has probably lagged for the last 3 or 4 or 5 years. The ability to raise prices, be more efficient than trucking, and on that score, truckers have actually done very well too. So again, if you believe that the price of the stocks leads fundamentals, then something good behind the scenes is happening here in terms of their revenues and their earnings.
What about also, though, we've got the upcoming CUSMA negotiations. I'm not sure if this is a bit of a stretch, but would any more, friction in trade between Canada, the U.S., Mexico, would that change things?
Potentially it could, but we've been talking about trade and tariffs for over a year now, and it's just kind of amazing how it's like the Teflon market for some of these sectors and some of these stocks. They just seem to be sloughing it off. And I don't know what that tells you, but it seems to be an optimistic viewpoint from the stock market, at least.
For sure. Okay, we'll leave it there. Greg Halter, Director of Research at Carnegie Investment Counsel. Great to have you today. Thanks for joining us.
Thank you.
Coming up, 3 big Canadian banks will report earnings tomorrow. So when we come back, we'll get a preview of what to expect. Stay with us. Second quarter Canadian bank earnings get underway tomorrow, starting with BMO and Scotiabank. Valuations now surpass their U.S. peers, but is the setup that much better for Canadian banks? Let's get some perspective now from Matthew Lee, equity research analyst at Canaccord Genuity. It's great to have you join us.
Hey, thanks for having me on.
So how do you see is the overall environment right now for Canadian banks?
Yeah, it's very positive, actually. I mean, if you think about the fundamentals of the business, we're in a situation where capital market is excellent. Credit is relatively benign, but not improving. Loan growth is still slow, but I mean, overall operating leverage is positive. So what you're getting is, on top of buybacks, a lot of earnings growth.
What do you see as the main drivers here for the potential earnings growth that we could see coming out this week?
Yeah, I mean, I think the number one thing you have to think about is capital markets, right? A lot of this has been talked about geopolitical oscillations. That helps trading revenues. That creates a lot of movement in the markets. The other side of that too is investment banking. Over the last year and a half, we've had a lot of people sit on their hands and wait to do transactions because they weren't sure about tariffs, they weren't sure about geopolitics. I think there's a lot more demand for M&A, a lot of demand for raising equities. So you're seeing both those businesses thrive. Wealth management as well has been a very strong part of the business. Obviously, equity markets have been constructive overall. That does help with AUM and AUM growth.
When it comes to M&A expansions in general, do you think Canadian banks should prioritize expanding their U.S. operations over other like international markets?
Yeah, it's a great question. I would say that overall M&A is probably out of favor right now. There's a great focus on ROE, return on equity in the Canadian banks, and I think that's a great thing for that to be occurring right now. ROE is fundamentally a basis of allowing for better profitability. So, to have better ROE is always an improvement. What I'd say right now is, in terms of expansion, there is definitely a better economic environment in the U.S. versus some of the other international businesses that these banks have. That being said, I don't think I'm necessarily pushing for additional M&A.
To what extent is the ongoing conflict in the Middle East a factor here? Like, is it a key driver of credit provisioning for banks moving forward?
I think so. And I think specifically those that have international exposure outside of the United States. So if I think about global economies that are both maybe lower GDP per capita and import fuel, so, Chile for BNS or Cambodia for national, those places are probably a little more challenged. And it's going to happen in two phases, right? First, it's going to be credit and provisioning, to your point, but also loan growth, right? Loan growth will be slower if the consumer is more pinched and corporations don't want to invest.
Yeah. Okay. So I do want to go through the banks and get your expectations for each of them. So you've got Bank of Montreal at a buy at the moment. What do you expect from earnings results from BMO?
Yeah, I think, all the banks across the board, I'm expecting earnings to be strong. And again, back to capital markets, right? But I think with BMO specifically, what we're looking for is more color on their ROE trajectory. BMO's great story right now is that they're going to have this 15% ROE bridge by the end of 2027 and into 2028. If you think about ROE exiting 2025, it was around 12%. So that's a huge amount of earnings growth just from kind of blocking and tackling and doing the right things. So we're interested in hearing more about that.
Bank of Nova Scotia is the next one. You've got this at a hold at the moment. Yeah. What about Bank of Nova Scotia? Anything stand out to you?
Yeah, I mean, look, BNS has executed well as well, but I think the international exposure, like I talked about before, that's a big risk at this point, right? Like, not that it's going to necessarily blow up, but the fact of the matter is that you have to be more cautious when you think about BNS, just because that international exposure, could be a challenge.
Canadian Imperial Bank of Commerce, you've got that one at a hold too?
Yeah, I mean, I like CIBC. I like what they've done. I think in the personal bank and the commercial bank specifically, they've done a very good job. My challenge with CIBC is more around valuation versus growth, right? So I think, where do you find that next leg of growth for CIBC? Where do you, find that next ability to push up revenue, push up earnings? I think that's the question for CIBC.
Next up is National Bank. So you've got this one at a hold as well.
Yeah, I mean, National Bank's very expensive, and for a good reason. They've done very well in trading. They've done very well in wealth. I would say that the two markets they're most exposed to, Quebec and Alberta, are both very strong. So, the fundamentals for National are good, but it is very expensive. It's the most expensive of the 6 Canadian banks, and to me, that gives me a bit of pause.
Royal Bank of Canada, what do you think? You've got this one at a buy.
Yeah, I do. And, Royal has always been a premium valuation for premium ROE story. It's going to be. And frankly, I think that their exposure to the U.S. on the capital market side gives them a leg up even against the peers in Canada. That being said, I think that they have to figure out another way to add an additional leg of ROE. That's the question for Royal.
And then last up is TD. You've also got that at a buy.
Yeah, I mean, I really like TD. I think they're executing well. They went through a lot of trouble with the AML a couple of years ago. They came out of that, and they've been repositioning their U.S. book. They've been doing a really good job with managing the Canadian bank. I talked about this last quarter too, but they have a massive retail footprint, right? And converting that retail footprint to wealth relationships, to commercial banking relationships, to deposits, to loans. I just think TD is in an advantage position in that front.
It's interesting, like when you look at all 6 of these banks, there's really not that much that's different about them, right? Is there ever going to be a time when we start to see some kind of gaining ground or seeing more growth than others within the category of the 6 big ones in Canada?
I mean, I would push back on that. I'd say that there is quite a bit of difference between them, in terms of how they're positioned from earnings perspective, right? Like U.S. exposure is a big difference. I mean, BMO and TD have large U.S. exposures. BNS is their international outside of the U.S., right? That's a big difference. And, the U.S. business isn't a small piece. For BMO, it's 30% of earnings. So, there is differentiation, but I would agree with you that the core business, lending, borrowing, capital markets, wealth, they're fundamentally the same. So I don't think you're ever going to really deviate from that. I would say, to take a phrase out of sports, it's a copycat league, right? So as one bank does one thing, and if it's successful, the other banks will try to do the same thing. I think we'll continue to see that probably for decades.
Okay, we'll leave it there. Matthew Lee, equity research analyst at Canaccord Genuity. Always good to have you on. Thanks so much.
See ya.
Coming up, a $120 billion investment strategy has been locked away for the wealthy until now. So we'll tell you how a new ETF is about to change that after the break. Stay with us. It's time now for the ETF report. The ETF market and investor interest in it continue to expand. Now, a $120 billion market is finally becoming accessible. So how to invest and is it worth it? Let's find out with Will Rind, founder and CEO of Granite Shares. It's great to have you join us. Thank you.
Thank you so much for having me.
So I know you wanted to talk today about auto-callable notes. Maybe explain first to our viewers what exactly that is.
Yeah, sure. So this is a product that was or is very big category for financial advisors. So structured notes, and particularly auto-callable structured notes, are about a $120 billion business annually here in the United States. And these are bespoke structures that typically offer a combination of a high yield and some dedicated downside protection.
So why have more everyday investors been shut out of this until recently?
Well, structured notes, the way that they're distributed or sold here in the United States and broadly, principally, these are products that are accessible just to financial advisors and or ultra high net worth investors. And that means that because of the bespoke nature of these things, they come with high minimum investment sizes, which can put off a lot of people and be obviously inaccessible to others. And so the ETF or the auto-callable ETF solves this.
So what does putting this into an ETF mean for someone who's watching at home and maybe wants to look into this?
So the biggest thing is that it marries the benefits of the ETF wrapper or the ETF itself, such as low cost, accessibility, traded on a brokerage, on an exchange and a brokerage account, with the underlying benefits of the auto-callable structure, which is namely a high yield and some downside protection.
Is this the buffered ETF story all over again?
It is quite similar to the buffered ETF. So buffered ETFs were also or are also a structured note category, much smaller than auto-callables, I should say, but still they're a popular structured note category. Buffered ETFs, these are ETFs typically that offer some downside protection, but they're not necessarily a yield product. They're just, for example, exposure to the S&P 500 or a major index with some downside protection. These have been very, very popular with investors over the last, let's call it, almost decade now. And we think that auto-callables are the next big market for the ETF industry.
Interesting. And you say single stock auto-callables are the next frontier as well. Why is that?
That's right. So, it's not just about broad indexes. Broad indexes, of course, will be popular, different thematic baskets, but also individual single stock auto-callables are also a big category themselves within the structured note world. So providing exposure to stocks such as Tesla, NVIDIA, stocks that don't normally pay a dividend, or if they do pay a dividend, it's going to be very nominal. And so for a lot of investors, they might already own these stocks, and it's another way to participate in the economic value chain of these most popular stocks by generating some high yield with also some downside protection.
And in your notes, you say one of the criticisms of auto-callables is point-in-time risk, so buying one note at the wrong moment. How has that been addressed at all, or how can you kind of deal with that criticism?
Yeah, so one of the major benefits that the ETF structure brings is it allows you to invest in a basket of order callables. So in a diversified pool of order callables, so you don't need to speculate on one particular exposure. So if you were to buy an order callable note from a bank, then you would take exposure to a particular yield at that time and a particular amount of downside protection. Now, that could be completely fine, but of course, if the underlying breaks through one of those barriers and has to be called and reissued, then you pay the expenses and the fees to do that. Whereas the ETF, that doesn't happen. You just invest in the ETF, one ticker solution. In that ETF, you have a number of different order callables, so you have diversification across different barrier levels and different prices. And that allows for the same diversification benefits as you would get with any sort of diversified pool.
I do want to talk about ETFs on a broader scale, because as we mentioned, the ETF market has continued to expand, ETFs exploding in popularity over the last couple of decades. What's driving some of that growth, do you think?
I think it's the basic value proposition of ETFs that, first and foremost, think of it as though the ETF is a new technology and the new technology is replacing the old technology, and that's the mutual fund. So that's at a sort of super macro level what's going on. But why is this new technology popular? Why is it replacing this old technology? And I think that's the ETF value proposition, which is typically low cost, tax efficient, liquid, in other words, available to be bought and sold in your brokerage account without any advisor fees. And I think probably now, which is somewhat underappreciated, but for those that are engaged in the ETF market, will certainly be very familiar to them, is the choice available is incredible. So you can buy ETFs on almost any underlying, and that's, really developing still at a rapid pace.
And just lastly, where are investors putting their money right now in ETFs? Are you seeing any trends?
Yeah, I think the main trend is first and foremost AI. So anything that involves AI or artificial intelligence, and that's everything from leveraged ETFs on AI stocks to AI baskets to value proposition or value chain proposition within the AI space. In other words, it could be data centers or memory plays, but anything really that involves AI or AI infrastructure. And then I think if you move away from the specific theme, it's things like yield or income, which in many ways are always going to be popular, but it's just different ways of finding yield for investors.
Okay, we will leave it there. Will Rhind, founder and CEO of Granite Shares, really appreciate your time. Thanks for joining us.
Thank you so much.
Coming up, we will put the focus on Canada-India trade as Prime Minister Mark Carney says a comprehensive trade deal with the world's most populous country would be a game changer for Canadian businesses and workers. Canada is working on a comprehensive deal with India to boost trade and investment. This comes as Indian Commerce and Industry Minister Piyush Goyal is in the midst of a 3-day visit. Prime Minister Mark Carney says a deal with India would be a game changer for Canadian businesses and workers. The two sides say they hope to conclude a deal by the end of the year. American firm Northern Oil and Gas is acquiring a stake in Calgary-based Parallax Energy. The $350 million cash and stock deal between the two privately held companies will give Northern a 25% interest in light oil-producing properties and 75,000 acres in the Duvernay Shale Basin in Alberta. And shares of Ferrari are in the red after critics took a look at the automaker's first fully electric vehicle. The unveiling of the Ferrari Luce drew largely negative reactions from industry analysts as well as social media influencers. The design of the $640,000 EV is being compared to mass market EVs. However, with a remarkable top speed, some analysts note that driving the car might deliver different views. And we're watching North American markets today. The TSX starting the day in the red, down by 0.6% after reaching record highs yesterday. S&P 500 on track to be up by about 1% at the moment. NASDAQ composite up above 1% to start the day, so we'll keep watching that for sure. India's Commerce and Industry Minister Piyush Goyal is in Canada this week with a large business delegation, and yesterday he met with his Canadian counterpart, Maninder Sidhu. The two sides are stepping up the pace to reach their target of having a trade agreement by the end of this year. And for more on the road ahead for economic ties between the two countries, I spoke with Victor Thomas, President and CEO of the Canada-India Business Council.
The Trade Minister of India is here. He's brought over 100 companies to this country, and they're looking to do business. And hopefully that's a great piece in terms of us not only completing a trade agreement, but actually seeing much more bilateral trade and much more bilateral investment. And it sounds like Canada and Canadian companies will be going there this fall as well to show the reciprocal interest.
Right, because the Indian minister did say that Prime Minister Mark Carney's visit to India earlier this year led to a complete overhaul of the Canada-India relationship. How critical has the political support been for reviving bilateral trade talks between the two countries?
Well, frankly, if you told me a year ago that we'd be having 100 companies from India coming to Canada this May, and the Minister of Commerce, I may not have taken you seriously. That's how much things have changed. Of course, I was there with the Prime Minister in March. And just to see the rapport of the two leaders makes a big difference, but then also to see pretty sizable commitments. One, to double trade by 2030, that $50 billion US number. And then, of course, this trade agreement. But there is conviction, and there seems to be follow-up to actually move in this direction. And the Indian Commerce Minister coming with such a large delegation proves that there's momentum.
Because that's what I was going to ask, like, how realistic is meeting those timelines, do you think?
Well, look, on the trade agreement side, we started in 2010. And so we've been at this a long time. And when you look at the last couple of years, some of our greatest allies have actually come up with agreements. New Zealand, Australia, last year, the UK, and of course, earlier this year, the EU. So, we're not alone. And we were ahead at one time, and now it's time for us to get hopefully even a better comprehensive trade agreement and get going on this economic relationship like never before.
Because Canada and India have announced a strategic energy partnership during Carney's visit to India on resources like LNG, LPG. Does Canada actually have the capability to step up delivery to meet growing demand from India?
Well, that's an internal question, and I think that's a question that many Indian companies are asking. Are you guys going to be able to have that steady, secure supply? And I think, we're seeing some initiatives in terms of us internally inside the country trying to figure out ways to do that. But it goes to show that there's demand. India wants to have that long-term stable contracts, and hopefully we can actually meet their needs. And with the show we're seeing this week in terms of over 100 businesses coming here, it shows that there's significant interest. And the Prime Minister's trip was significant because it happened on the same weekend when the Iran war started. And we just saw, even over those 3 days, the price of oil, for example, go up dramatically. And we've seen, everyone knows in the months since how much, the commodities and some of the things that we have in this country are needed, not just around the world, but specifically in India.
And your council's members include some of Canada's biggest investors like Brookfield, Fairfax, the pension funds. What's on their wish list of the steps they want the Indian government to take to help Canadian businesses?
Well, I think, I'm meeting with all of them tomorrow with the minister. But my sense is to say, just clear path in terms of being able to place capital projects that are at the scale and size of their check size. And then also, being able to foresee the needs and interests of the country. There's so many different projects right around the country, but there's very specific projects typically that these major funds have done, mainly around real estate and infrastructure. But, I think India is also trying to say, hey, might you be interested in some of our venture? Might you be interested in some of our other types of investments? And so that'll be part of the conversation tomorrow.
CUSMA also comes up for renegotiation this year. That is a much bigger priority for Canada than any other trade deal. Obviously, it's with our biggest trading partner, the U.S. and Mexico, of course. How much bandwidth will Canada have to finalize a trade deal with India this year, given that, Canada might be a little busy?
Well, there's no question CUSMA is of highest priority. But I think it can't be either or. We have to be able to do both. And India happens to be the most populous nation on earth and the largest, fastest growing economy. And so while we have to make sure we are in sync with our neighbors to the south, we also have to make sure that we're tying into the largest growth market in the world. And we have to. We started a long time ago, and we have to get it to completion and across the line this year.
Do you think when we're factoring in the U.S., do you think Canada can really rely on India as a trading partner, an alternative trading partner to the U.S., given the trade war that's happening between the two countries right now?
Yeah, that's a fair question. I think there's a lot of geopolitical instability in the world, and that geopolitical instability is also pushing these two countries together at a pace we've never seen. And so, why is India here with 100+ companies? Well, because they are keen and interested to find long-term stable partners. Why will we be going? Why was the Prime Minister there in March? Is that both sides are keen and interested, and let's make a deal. But let's actually see many more actual commercial transactions take place.
That was Victor Thomas, President and CEO of the Canada-India Business Council. Well, a South Korean submarine docked in Victoria for joint exercises and to showcase its bid to replace Canada's aging submarine fleet. CTV's Adrian Gabriel has more in this report.
Promising to usher in a new era of middle power might, the Republic of Korea Navy cut through Canadian coastal waters this weekend. On board its KSS-3 submarine, a bid is in place for Canada to purchase 12 of these South Korean-made subs. The only other finalist vying to deliver Canada's next-generation submarine is a joint German-Norwegian bid. Ottawa will announce the winner of the contract this summer, which could come with a price tag of $25 billion. Korean Navy gave CTV News a tour inside the submarine that could be the centerpiece of Canada's naval future. We were forbidden from taking any of our own video inside. Korean Navy provided footage shows their crew in action. The submarine is more spacious inside than Canada's aging fleet, with the capability to deploy both anti-ship and land attack cruise missiles.
The South Korean KSS-3 is 89 meters in length. It weighs 3,600 tons, can accommodate up to 50 personnel, and stays submerged for up to 3 weeks.
I just want to say thank you.
One of two Canadian submariners who traveled with the Korean Navy shared this analogy when comparing the Korean sub to Canada's.
It's kind of like buying a brand new Tesla, and then you're coming out of a 99 Honda Civic.
The Canadian Navy's 4 Victoria-class subs were first built in the 1980s. Only one is currently operational.
You have 3 oceans to patrol. How difficult does that make your job?
I do not have enough ships to patrol and to protect Canada like we should, which is why we're investing.
Currently, the Canadian Navy has approximately 200 submariners. They will need at least 1,000 strong to operate a fleet of 12 submarines.
This is all about democracy and freedom.
The ambassador of the Republic of Korea to Canada believes his country is well positioned to help protect Canadian coastal sovereignty.
Middle powers need to work together, and Korea stands ready to work together with Canada.
In increasingly troubled waters, the Canadian government is focused on forging friendships as it rekindles historic military alliances.
With a decision expected as early as this June, whoever is chosen to deliver Canada's next-generation submarine is poised to play an integral role in shaping the country's Navy for decades to come. Adrian Gabriel, CTV News, CFB, Esquimalt.
Coming up is Hot Picks. We will zero in on 3 plays in the utilities and power sector. Stay with us. It's time now for Hot Picks. Today we are looking at 3 plays in the utilities and power sector, and our next guest sees the sector shifting from defensive to growth, driven by data center demand tied to AI. So let's welcome in Andrew Weisel, Managing Director and Analyst at Scotiabank. It's great to have you join us.
Great. Good morning. Thanks so much for having me. Great to be back on the show.
Of course. Before we get into your top picks, that's an interesting way to start things. The reason behind the growth of this sector is tied to AI. When do you expect to see growth? Are we already seeing it? What does the sector look like right now?
We're definitely seeing it. We're not quite at the inflection point. We're seeing a lot of announcements today. We are seeing activity, of course. I mean, everyone's using AI day to day already. It's really 28, 29 that we're going to see the real ramp up. Today's where we're seeing announcements, we're seeing dirt moving and construction starting to happen, but it's really the planning period now. It's the next few years where we're going to really see the excitement start to happen. But it's today that we're seeing the really important critical steps of planning, and importantly, make sure that the rest of the world is not negatively impacted by that, especially from an affordability perspective. But it's a very exciting time now.
Are you starting to see more investor interest because of that?
It's funny, we're getting tons of questions, but the truth is utility stocks are getting left behind, right? It's all-time highs for the markets, incredible growth for the S&P 500, and we're getting lots of questions about how are utilities affected. Utility stocks are not necessarily the most exciting way to play this, though. When you think about earnings growth for the market is incredible, utility earnings growth is robust, but it's not the fastest growth in the market out there today. It's exciting, but we're not necessarily seeing utility stocks driving the market, right? Lower beta, maybe not the most exciting sector out there.
Interesting. Okay, but at least people are starting to get curious about it. Let's get into your hot picks now. Your first one is Entergy Corporation. So just tell us, first of all, about this company and why you like it.
Yeah, Entergy is a very exciting one. They're a utility in Louisiana in the Gulf Coast part of the country. Historically, not necessarily where people would have thought data centers would play, but they've become a clear winner. Meta is one of the marquee customers. Meta first came to Louisiana service territory in a big way about 2 years ago. What I really like about this story is positive estimate revisions. Most utilities only really revisit their earnings and CapEx outlooks once a year. What I really like about this story is they're not afraid to revise that outlook as needed. What I mean by that is when the companies, Meta and the other hyperscalers too, it's not just Meta, but when they have news to bring, the management teams are not afraid to come to the market, share that publicly with regulators and investors, and revise the outlook. Since Meta came to town less than 2 years ago, Entergy's management has revised the outlook over 4 times. They give 2028 EPS guidance. Most utilities don't give visibility that far out to begin with, but Entergy has revised the 2028 outlook 4 times. They've increased it by over 20%. You don't get that kind of upward revision in this sector. Most recently, Meta came to town. Entergy increased the CapEx budget by 33%. That's $14 billion of spending. Meta is happy to pay for these gas plants themselves to power it because they want speed to market. Louisiana regulators want the local business development and economic progress. It's great for the local economy. Customers are benefiting. Entergy has identified $3 billion of affordability benefits just for Meta, $7 billion altogether. Great for customers, great for investors, great for AI, great for the economy. It's a real win-win-win.
What's the appeal of Northern Louisiana for Meta and other hyperscalers? Like, why there? Is it because of the regulators, as you mentioned?
It's a great question, and I'll be honest, it was not on my bingo card 2 years ago. You've got a very supportive local environment. The politicians are behind it. The regulators are behind it. They created a new system, a new approval process called Lightning. Everyone wants speed to market in the tech world, right? That's in a lot of ways the bottleneck is how can I get electrons faster to build all this stuff? Mm-hmm. And the local ecosystem is very supportive. You have land, you have a workforce motivated, you have the politicians and regulators supportive, and you have cheap electricity. The utility is saying, hey, we're open for business. We want to make this happen. And in a lot of ways, the stars aligned. Once you have a proven setup, it's a very open for business environment where it's working. And so you've got a lot of very positive momentum. I mentioned it's not just Meta. Once they're open for business and it works, others are coming to town as well.
Okay, so let's get to your next pick, and it is WEC Energy Group. Tell us more.
Yep. So WEC is a Milwaukee-based utility. They also have a great data center story. Microsoft is their core data center tenant, if you will. Similar story here, where they have a proven setup where Microsoft has been adding more and more. Most recently, Microsoft added 500 megawatts to their setup. Altogether now, WEC has nearly 4 gigawatts of data center story there. unlike Entergy, WEC is not so much about the positive revisions. They're more about consistency. For 2 decades, WEC has developed a track record of delivering year in, year out. Good economy, good weather, bad weather. They deliver the high end of guidance year after year after year. Now, the stock has fallen a little bit out of favor, partly because of regulatory concerns. They're primarily in Wisconsin, also in Illinois. In Wisconsin, they've done something really creative. They have a dedicated tariff. I don't mean tariff like trade wars and international trade, but tariff meaning how they build the data centers. So now when Microsoft and other hyperscalers come to the Wisconsin area, they have dedicated assets, meaning brand new state-of-the-art gas or whatever they want just for them. That gives them certainty of the quality and also of billing. They know exactly what they're going to pay and how they're going to pay it. That also protects everyone else. I've mentioned affordability. That's a big concern for this industry. Everyone else knows they're not going to be bothered by what the hyperscalers are doing, and the hyperscalers know exactly what they're going to pay. I also briefly want to mention Illinois. WEC has a gas utility in Illinois. There's all kinds of decarbonization concerns there. But in Illinois, they settled their gas rate case. That's really hard to do in Illinois, and that suggests good alignment between the utility and the regulators. To me, that gives me a lot of confidence they're on the right path to spend on things like gas pipeline and safety.
Okay, we are a little short for time, but I do want to get to your last pick. That's CMS Energy Corporation. Tell us why you like this one as well.
So my mantra here is that defense is not winning championships these days. I kind of made the joke that utilities are getting a little left behind given that the market is all in risk-on mode. CMS is a very high-quality, sleep well at night, incredible track record like WEC. CMS just does not miss guidance. They're extremely sleep well at night kind of story. Now, Michigan was slow to the data center game, and CMS delivers 8% EPS growth year in, year out, kind of without any help from data centers. What I like about them is that they will continue to deliver on growth without data centers, but management is getting more and more confident that they do see prospects for data centers. It might not be tomorrow, it might be later this year, but we're optimistic that they're going to get that upside. Even without it, they can deliver 8% EPS growth. They have a very good regulatory setup. They're about to get they're about to file their long-term generation plan, adding gas, renewables, and storage. That's going to bring some catalyst later this year. They've also been doing very well with rate cases, generation, you name it. Key is it's a sleep well at night story. If anyone's at least a little skittish about the war in the Middle East, the market may be a little uncertain in terms of how certain or stable or diversified it is. CMS is a really good, it's what a utility should be.
Okay.
High quality, sleep well at night.
All right, Andrew Weisel, really appreciate your time. Thanks for joining us.
Thank you.
Coming up, we'll tell you how a couple of AI trainers are earning up to $25,000 a day to automate Wall Street workflows. Stay with us. A couple of AI trainers in finance $25,000 a day to tell bankers what's missing from their AI plans. For more on this, we spoke with Matthew Bloxham of Bloomberg Intelligence, and he says it looks like an eye-popping number, but when you put it in perspective, it's actually not that outrageous.
If you're a specialist trainer and perhaps got 20, 30 people in a training class, then maybe $1,000 a day per employee isn't quite so eye-watering. And I think it kind of talks to this big disconnect we've got right now between the amount of investment going in to AI technology and the capability of that technology and the ability of staff across a whole range of industries to actually tap into that and improve their productivity. And that's really what I think management across a range of firms are looking to do, is kind of help their staff unlock the capability of these hugely powerful tools so that they can improve their personal productivity and the productivity and the competitiveness of their organizations.
Okay, that wraps up this edition of The Open. Morning Markets is up next.